So this is a paper called International Momentum Strategies. It's written by Geert ROUWENHORST from the Yale School of Management, and it was published in August of 1996 and later revised in February 1997. Okay, so let's dive in here. So there have been a lot of papers in the past that have related stock returns to past performance. For instance, back in 1993, Jagadish and Titman found that over medium-term horizons, performance persists mostly over the next 3 months to 1 year. And then DeBont and Thaler found that there are reversals over longer time periods, particularly over the 3 to 5 year past performance. Stocks tend to earn a higher average return than firms that performed well over the past 3 to 5 years. And so there's been a lot of debate over what's causing this. For instance, it could be an improper response by markets to information, or it could be explained by market microstructure biases or by properly accounting for risk. And Fama and French back in '96 showed that long-term reversals can be consistent with their multi-factor models, but those models don't explain the medium-term performance continuation. And around the same time period, Chan and Jagadish and Lakanishik found that medium-term return continuation can be partly explained by the underreaction to earnings information, but price momentum is not subsumed by earnings momentum. So price momentum and earnings momentum use different pieces of information to earn similar returns, but don't replace each other. So in this paper, the authors are going to explore the international markets and how they relate to momentum returns. Prior to now, most of the papers have used just U.S. stocks in their analysis. And so there have been studies, for instance, Asness et al. And Richards, who studied momentum trends at the country index level. However, in this paper we're reading right now, the authors are going to dive even deeper and go into the actual markets to look at the individual stock level across over 2,000 stocks and from 12 European countries from the 1978 to 1995 period. And this paper will explore just the medium-term returns since we've got such a small sample time period. And this time period seems to overlap with the time periods used in prior papers with U.S. equities only. And so the authors note that there may be similarities because the U.S. equity securities may the source of those returns may be composed of some of the international market factors as well. However, the U.S. Continuation of returns doesn't seem to be related to those factors. And so if this study finds that the international markets don't have persistence of returns based on the past returns, or if those returns are normalized with conventional measures of risk, then we could say the U.S. market experience with momentum is simply a fluke and is not representative of a typical equity market. And so if it turns out that there is momentum found in the international equity markets, then it seems that momentum is a pervasive anomaly across all markets. And so either the risk calculation that is used is flawed when trying to determine the abnormal returns, or it may turn out that investors generally underreact to new information. And so the main finding of this paper is that an internationally diversified relative strength portfolio that invests in medium-term winners and sells medium-term losers tends to earn around 1% per month. And this seems to occur in all 12 market samples. It seems to hold across all the deciles that they put the portfolios into, and it does seem to work better for small firms than large firms, and that outperformance tends to last over the next year, and it can't be attributed to conventional risk measures. And in fact, they found that controlling for market risk or exposure to the size factor actually increases the abnormal performance of these momentum strategies. There does, however, seem to be a common factor between the European and US momentum strategies. And so this common factor may be what's driving the profitability across all the markets. And so the rest of the paper is organized as follows. Section 1 describes the sample and documents the profitability of the momentum strategies. And Section 2 shows that the momentum strategy's success is not isolated to a particular country or size of company. And Section 3 tries to examine whether returns can be explained by conventional asset pricing models. And then Section 4 concludes based on the studies. So let's look at Section 1, returns of relative strength portfolios. So as discussed before, they're going to use the returns in local currency for 2,190 firms in 12 European countries from the period 1978 to 1995. And so here they have a list of all of the 12 countries that they're going to use, as well as the number of stocks within each of those countries. And in each of the countries, the sample of stocks covers between 60 and 90% of each country's market capitalization. So that's a large percentage of the country's market. And all the returns are converted to Deutschmarks for purposes of comparing the returns. So it looks like they're going to use the same portfolio formation process as Jagadish and Titman in their 1993 paper. So at the end of each month, the stocks are ranked according to their past return, and J is the number of months of that past return. So they're going to rank them based on their past 3-month, 6-month, 9-month, or 12-month returns. And then based on the rankings of which stocks performed the best and worst over the past J month period, they will allocate them to 10 deciles, with the number 10 decile portfolio being the winner portfolios. That's the ones that returned the best over the past J months. And then the lowest portfolio 1, will be all the loser stocks who performed the worst over the past J months. And so each of these portfolios is equal weighted at formation and then held for K months. So they could be held for 3, 6, 9, or 12 months. And they're not rebalanced during that time, so it's a buy and hold for K months. And also they note that the portfolios will overlap because the returns are in a 1-month variation, but the holding periods can be 3, 6, 9, or 12 months. So a new portfolio is added to the overall portfolio every month and then held for the next 3 months. So you could say that 1 over K of the portfolio is revised and replaced each month. And so the returns that are presented are kind of an average of all these new portfolios that are formed each month. So they give an example here where the portfolio where you have to hold for the next 3 months based on the prior 6 months return, that portfolio would be composed of 3 different portfolios. For instance, one from 3 months ago, one that was formed 3 months ago based on the 6-month prior performance before then, and then 2 similar positions resulting from 2 months ago and from 1 month ago. And then the next month, the oldest portfolio will be liquidated and replaced with a new portfolio based on the current past 6-month performance. So Table 1 presents the results and the average monthly return from building the portfolios this way. So let's take a look at Table 1. So let's take a look at the structure of the table first. Over here we have the J. This is the number of months of past performance we use to form the portfolio. And here we have K, the holding period. That's how long we'll hold the portfolio before we sell it. And so for each of the J and K periods, we have the return, the monthly return of the loser portfolio. That was the one that had the least past performance based on these number of months. We have the winner portfolio, which had the highest past performance across this number of months. And then we have the winner minus the loser portfolio. And so that would be as if you bought or went long the winner portfolio and sold or went short the loser portfolio. We'll call that the zero cost portfolio. And then we have a T statistic to see how significant these returns were, and if we can conclude that they are likely to not be zero. And so we have that structure across all of the different J and K periods. The first thing to note is that in all cases, the winner portfolio exceeds the loser portfolio. So we have a positive value here in the winner minus loser portfolio. So going long winner portfolios and going short the loser portfolios gives us an excess or earns us a profit. Also interesting to note is that with each increase in the past 6-month return, each increase in J, we have an increase in the profit, arbitrage profit that we can get. So 0.007, 0.011, 0.012, 0.021. Excuse me, 0.0135. Also really interesting to see, as in most cases, as the K, the holding period, increases, the excess returns from the strategy actually decrease. So we go from 0.0135 to 0.0064. The 9-month formation period decreases almost monotonically. And a similar case here in the 6-month formation period, not so much in the 3-month formation period. But in general, we can see that buying past winners and selling past losers can earn us a return of right around 1% across all formation and holding periods. And all of these returns are very significant, at least at the 5% significance level. And so that was the results of Panel A. Panel A's returns were as if the portfolio was purchased on the day that the portfolio was formed. However, Panel B lists the returns as if the portfolio was purchased a month after the portfolio was determined. And in this case, all of the returns here are much higher than the Panel A case. And it's mostly because the loser portfolios earn even less. And that widens the gap between the winner and the loser portfolios. And it still looks to be the case where with each increase in the K, the holding period, the returns tend to decrease across all the formation lengths. But there doesn't seem to be as much of an effect where the increase in the J, or the formation period, causes an increase in returns. It seems that the monthly returns tend to be about the same across all of the formation periods, all of the more longer term formation periods anyway. Okay, so let's go back up to the discussion. It looks like he's going to analyze just the 6 month returns going forward. That way he can dig a little deeper into that particular strategy, rather than having to go through all of the different J and K periods. We're just going to do the 6-6. So it looks like table 2 breaks down the 6-6 strategy into the different deciles, so we can look at those at a more granular level. So let's go down to table 2. Okay, so we have here each of the deciles. So the loser portfolio is the one that performed the worst over the past 6 months, and the winner portfolio is the one that performed the best over the past 6 months, and all of the deciles in between. And then we have the average return over the next 6 month holding period. That's a monthly return. The standard deviation, the market beta of the MSCI, and then we have an average size variable here too. And down at the bottom we have the winner minus loser statistics with the average return, standard deviation, and the beta. And it makes sense here that we have our beta is basically 0 because we have a zero cost portfolio where we're selling and or going short securities and going long securities, so the beta will be 0. Okay, so let's take a look at the results. And the first thing we notice is that the average monthly return of the portfolios increases monotonically as the increase in the decile. So as the past returns increase, so do the holding period returns. So a past 6 month return tends to be associated with a higher future 6 month return. And we notice that the T statistic and the F test note that it's very, very unlikely that the difference between the winner and loser portfolios is 0. And interestingly, the standard deviation, as the portfolio decile increases, or the past 6 month returns increase, the standard deviation seems to be a U shape. So the more extreme portfolios tend to be a lot more volatile than the less extreme portfolios. And we note that the winner minus the loser strategy exhibits about the same standard deviation as the middle decile portfolio. And so this means that this may not be a very well diversified strategy, because you would think that the buying or going long and going short securities, especially with a beta of 0, would have a lot less volatility than going long your normal momentum portfolio. And in the last column we see the average size specifics. We note that the average winner portfolio tends to be a lot larger than the loser portfolio. And so what we would typically see is that a smaller size portfolio or company should have a larger return. We actually have the opposite in this case, where the largest returning portfolios actually has larger size and market capitalization than the portfolios that return the lowest. And so that would maybe signal to us that the source of the momentum returns may not necessarily be their size. Another thing to note is that the extreme portfolios, for instance the winner and the loser, tend to have smaller companies than the average portfolio decile. So it seems like this buying winners and selling losers strategy may typically be smaller capitalization companies than the overall market that's being invested in. Okay, so now let's go back up to section 2. This is called the relative strength strategies that control for country and size. So here the authors note that even though there were 12 different international markets that were used, some of the markets and countries are larger and represent a larger sample size within the population than the other countries. For instance, the UK, France, and Germany seem to make up most of the sample, whereas the smaller European countries make up the rest. So this gives us 3 questions. First, does that mean that the momentum returns maybe come from just one or a small subset of all of the markets? And secondly, there weren't any restrictions placed on the geographical composition of the portfolios, so they didn't limit the number of stocks or capitalization that could come from certain countries. And so did maybe the strategy select from a single country? And so it looks like maybe we'll take a look at each country individually to see if the momentum effect is present there. And finally, from table 2, we saw that the portfolios are kind of tilted towards small stocks. So it looks like we'll take a deeper dive into the influence of firm size on the relative strength strategies. And so let's go down to section A, relative strength portfolios by country. And so it's been found in prior research that large country factors tend to influence the international markets. And for instance, a shock in a large country can really influence an entire international portfolio due to not properly being diversified. And for instance, in our case, if strong past performance of German stocks relative to other markets occurred, then our portfolios for the winner portfolio will be very much overweighted toward Germany relative to other European markets, and vice versa for the loser portfolio. So then others have found that maybe the return continuation, the success of the momentum strategy, is primarily due to country-specific market performance. And so in order to take the country momentum piece out of the returns, we're going to control for the geographical composition of the relative strength portfolios. And then we should be able to see if the returns actually reduce when we mess up that country-specific allocation. However, if we see that the persistence of returns continues on, even though we controlled for the geographical composition, then we could say that the momentum returns are actually idiosyncratic and at the firm level and not necessarily at the country level. Okay, so here we describe how the country-neutral relative strength portfolios are formed. So it looks like each country is going to have its own decile ranking between the loser and winner portfolios. So rather than grabbing stocks from the entire 12 countries, we're going to split up the stocks into their own countries and form individual portfolios from within each country. So we'll do it the same way we did before with the deciles according to the past 6-month returns and equally weighted portfolios, but will have 10 deciles from each country. And then each decile from each country will be combined with the decile from the other country, so that, for instance, the 10% of stocks from each of the countries with the lowest past 6-month returns will all be assigned to the loser portfolio, and the same thing for the top portfolio. So in that way, for each country, 10% of the stocks are put into each overall decile. So it would be very difficult for one particular country or subset of countries to overtake the entire portfolio's allocation. So it looks like table 3 has the results of this. So let's go down to table 3 and see how the returns turned out. So looking at panel A, the country neutral momentum strategies, we have each individual country's winner portfolio minus loser portfolio monthly returns, as well as the standard deviation and the t-statistic over the returns. And then we have the all stock strategy, the country neutral strategy, where as we discussed before, each country has the opportunity to put 10% of their stocks into the overall portfolio according to the ranking deciles. And so we see here that using the country neutral strategy, the mean monthly return of buying winner and selling the loser portfolio is about 0.93% per month. That's a little bit lower than what we found when we don't control for geographic composition, which was 1.16%. And so, since there's not much of a difference between the country neutral return and the return of the one that is not adjusted for country specifics, then we could say that the country momentum effect does not significantly influence the international portfolios. One thing to note, however, is that the country neutral portfolio tends to be better diversified than the non-adjusted portfolio. Its standard deviation is 0.0239, which is a lot less than the 0.0397 that we saw before. And we also have a much higher t-statistic here for the mean. So we would say that it's very unlikely that this excess return is zero. Okay, so now let's take a look at each of the individual countries and their return. The first thing to note is that in every single one of the countries, the winner portfolio outperformed the loser portfolio, because all of these are positive. And also important, 11 out of the 12 countries had a t-statistic that was above 2. So all of these returns, we can conclude that it's not very likely that they're zero. Sweden, though, we would say is probably no excess return between the winner and loser portfolios. And we see that some of the countries did better than the others. For instance, looks like Spain did the best, the Netherlands, and then Belgium. We also noticed that the standard deviations here are a lot higher than the totally diversified portfolio, the portfolio that was allocated across all of the countries. And to sum up our conclusion here for this section, the momentum strategy is not country specific. It actually is pervasive across all countries and is more restricted to idiosyncratic aspects of individual firms. Okay, so let's go back up to section 2B. Size neutral relative strength strategies.